So, welcome to this LBTT and ADS update. My name's Isobel D'inverno. I'm Head of Corporate Tax here at Brodie's, and I'm joined by my colleague Bob Langridge, who is a Senior Associate in our team. So this morning we're going to be talking about a number of LBTT related topics, the ongoing questions about what's residential and what's not residential, multiple dwellings relief, ADS issues for couples, a bit about the ADS consultation, which is currently going on, something about market value and partnerships and companies, and finally a VAT update on an important area of VAT that's been or will be changing shortly. We're going to start off with the residential non-residential divide, and Bob's going to talk about that. Bob.
So this is a very brief update on me. If you've watched any of our previous webinars, either live or on YouTube, you'll know that we've kind of frequently been giving updates on what has become a bit of a vexed question about what are garden and grounds for the purposes of the SDLT and therefore the LBTT residential property definition. As a quick recap, residential property for SDLT and LBTT and LTT if you're Welsh is any building used as a dwelling or suitable for use as a dwelling, together with its garden and grounds and any other buildings on those gardens and grounds. So the question of what is gardens and grounds, particularly when you're dealing with larger properties, has become fairly heavily litigated in recent years. And now we have the sort of first really substantive bit of authority on that question, albeit it's English authority and the decision is quite limited. And this is the decision by the English Court of Appeal in the Hyman and Goodfellow SDLT cases. Both of these cases involved large houses with extensive ground, 3.5 and 4.5 acres, plus a number of other buildings included with them. In Hyman, there was a disused barn and also a bridleway path. And in Goodfellow, there was a garage with an office above it, as well as some stables and paddocks. Goodfellow is quite interesting because in that decision, they make a lot of hay, pun not intended, about the fact that this was an equestrian property. In the first tier and upper tier tribunals, in both cases, HMRC successfully argued that the purchases were wholly residential and that things such as the stables, the paddocks, and the bridleway all fell within the definition of garden and grounds, which had to be given their ordinary English language meaning. In the Court of Appeal case, the two taxpayers here sought a joint appeal against the decisions, and their grounds for appeal, because they couldn't appeal on facts, they had to appeal on law only. Their appeal was that the tribunals had got the law wrong, because when you look at the definition of residential property, you ought to read it purposively, and as part of that purposive reading, you ought to read in a restriction that residential property only includes garden and grounds to the extent they are necessary for the reasonable enjoyment of the dwelling. Next slide. The courts here, quite unsurprisingly, to be honest, held that there's no such limitation, and there is no grounds on any of the sort of grounds of statutory interpretation or the canons of statutory interpretation to read such a limitation in. They felt that the statutory wording was clear and unambiguous, and they sum it up quite pithily. Land does not cease to be residential property merely because the occupier of a dwelling house could do without it. So this is really the first major decision kind of confirming, if you like, what has become HMRC and Revenue Scotland orthodoxy over the last few years, that even property with extensive grounds attached to it can still all be residential. There's no kind of major decision which gives a positive curtailment of what garden and grounds are. And the best we have to go on at the moment are really from these first-tier tribunal decisions, where there does appear to be a line of thinking developing that garden and grounds is that land which bears some form of functional relationship to a dwelling house. In other words, it doesn't have a function independent of the dwelling. That's all I need to say about that. I'll hand over to Isobel for multiple dwellings.
Thanks, Bob. So multiple dwellings relief can be claimed where you buy 2 or more dwellings in a single transaction or linked transactions. It's moderately complicated, but it's certainly worth going through the pain of working it out because the tax savings can be very significant. You can claim MDR even if your overall purchase is subject to LBTT at the non-residential rates, because the overall purchase includes non-residential property. So bizarrely, you can have an overall tax rate which is non-residential, but still claim the multiple dwellings relief. You have to claim it in an LBTT return, and it's better to claim it in the original return if you can, because claiming it by amending the return can lead to Revenue Scotland inquiring into it, because there's been a lot of activity from specialist advisory firms who are sometimes referred to as claims farmers, trying to tell taxpayers that on a recent purchase they could have saved money if they'd claimed MDR or other types of amendments to returns. So it's far better to claim it in the original return if you can. Moving on to the next slide, how does it actually work? Well, it's really about doing 2 calculations of the LBTT and ADS on the dwellings. The first one is that you work out LBTT and ADS at the residential rates on the average price per dwelling and multiply that by the number of dwellings. That gives you one figure. The other figure is the minimum prescribed amount, and that's 25% of the LBTT and ADS on the residential property without MDR. So whichever of these is the highest, that's the one that applies when you claim MDR. With the ADS, you end up paying ADS effectively on the average price per dwelling. That doesn't really matter in most cases, but you may have replacement of main residence treatment if one of the new properties is a replacement. And that effectively means that you only get relief for the ADS effectively on the average price. So that's something to bear in mind. Moving on to the next slide, the LBTT multiple dwellings relief can be claimed across linked transactions. So if you buy more than one dwelling in linked transactions or in transactions which are linked, then MDR claim is possible. What are linked transactions? They're transactions that are part of a single scheme arrangement or series of transactions between the same seller and buyer or persons connected with them. So the transactions have to be linked in some way so that the purchase of one affects the purchase of the other and so on. But they also have to be between the same parties or persons connected. And with the connected persons definition, it's important to actually check out whether the people are connected or not, because not all members of a family are necessarily connected. In the example below, if you had the same seller selling 3 properties, one to a mother, one to the son, and his spouse, and one to the cousin, who the niece of the mother. The mother and son and his spouse are connected persons, so those would be linked transactions, but the cousin isn't connected, so that one wouldn't be part of the linked transactions, so wouldn't come into the multiple dwellings relief calculation. It might well be treated as an acquisition on its own, so that might make a better result anyway, but you have to drill into who are connected. And similarly with single transactions, what is a single transaction? Well, it's something where it's really just part of one deal that's joined together by a single contract or an overarching agreement. It doesn't need to be a single interest in land, and it can complete at different times. But where it's relevant for multiple dwellings relief, you can have more than one seller and a single purchaser, but you can't really have more than one purchaser. So in the example we just looked at, you can't say that the acquisition by the cousin is part of a single purchase with the acquisition by the mother and the son, because that it isn't really a single purchase, because there are two different purchases involved. So multiple dwellings relief does require a fair bit of looking into in order to be sure that all the conditions are met, but it's certainly worth doing so in order to get the benefit of the relief. What happens, I think, on the next slide, if you miss a claim? Well, these claims farmers we mentioned may tell you that you can go back and claim even a long time after the purchase, but actually you can't. You can amend an LBTT return up to 12 months after the filing date. You can do what's called an overpayment relief claim, and that can be made up to 5 years from the filing date. But despite its name, an overpayment relief claim can't include a claim for a relief. So it can't be used for a missed MDR claim, despite what is often said by claims farmers and so on. And as we've mentioned, if you do amend a return to include an MDR claim and this results in a repayment, well, first of all, Revenue Scotland will often check before they repay, even though it's a self-assessment system, and often it could lead to an inquiry into the return. So it's far better to include it at the beginning if you can. Right, I think we're moving on to ADS now, which Bob will speak about.
Yep, thank you, Isobel. So I'm going to talk about 3 cases today. You will see from the case reference numbers that these have been heard pretty much sequentially. Most of the cases that are being heard by the first tier of the Scottish Tax Tribunal are in fact ADS cases. Of these 3 cases, I'm going to briefly mention Mohammed and Christie, because they turn on broadly the same problem. And within ADS, which is known to be a bit of flawed legislation, they are things that we know are problematic, and we kind of live with that problem. But the Crawford case I'm going to talk about a little bit more, because it's a bit more of a surprising decision, and it just, to me, really highlights some of the errors, the deep structural errors in this bit of tax legislation. So in Mohammed and Christie, the facts are relatively similar. In both cases, the taxpayers own homes in the UK. They were posted abroad by their employers. I don't know who Mr. Mohammed's employer was, but Dr. Christie was a major in the army and had to go to his posting in Canada under the Armed Forces Covenant. They both spent several years abroad while owning in the UK the homes they had intended to live in. When they returned to the UK, they were both given postings to Scotland, bought homes in Scotland. This triggered the ADS, because at that point they now owned 2 dwellings. the old dwellings that they intended to live in but hadn't been able to due to their postings, and the new Scottish ones. When they sold their old homes, they sought repayment of the ADS, and in both cases they were denied it by Revenue Scotland and then by the tribunal. And it's easy to see why from the legislation, but kind of hard to believe that that accurately reflects the government's policy. The reason they didn't get the repayment is because under the legislation, in order to reclaim ADS, once you've paid it, you have to be disposing of a main residence. And that means you have to make the disposal within 18 months of buying the new home. They both did that, but also that you need to have lived in the old home as a main residence in the 18 months prior to the sale. And that's where Mr. Mohammed and Dr. Christie both fell foul. Due to their employment circumstances and their armed service, they simply were not able to live in those properties and were thus denied the reclaim. That's a very unfortunate result, but it is, I think, legally correct. That is what the law says. Though when one reads cases like this now, you wind up feeling sorry for everybody. You feel sorry for the taxpayers, but you also feel sorry for the tribunal having to hand down these judgments, but also for Revenue Scotland, who now in every judgment are making the point, we don't have any discretion in how we apply this law. On to Crawford, which is the more surprising of the decision, and unfortunately it does involve me talking about the actual wording of the statutes a bit, so please bear with me. But if we go on to the next slide, we have Dr. Crawford and his partner, Ms. S., both of whom owned and lived in separate property. So they were a couple, but they weren't living together. Dr. C owned the first property, Ms. S owned the second. Before they bought their house together, sorry, no, not before they bought their house together, on the day of the purchase, Dr. C sold his property. So if we flip over to the next slide, Dr. C has sold his first property, and they have bought in joint names a new home together. Miss S retained her home. This means that the ADS was payable on the purchase of the joint property. And there are two routes to getting to that result, the one we're familiar with and the one you might be less familiar with, which is the way the tribunal viewed it. The kind of familiar thought process is, oh, well, they moved in together, therefore they're cohabitants, so there's a single economic unit rule that applies, and therefore he's deemed to own what she owns, so they are both caught. That wasn't the argument here. The argument here is a little more insidious, and that is that paragraph 5 of the LBTT Act Schedule 2A, the ADS legislation, brings both purchasers within the ADS if one of them is caught by the ADS. So the fact that Ms. S triggers the ADS is enough for Dr. C as joint purchaser to be brought into the ADS charge as well. And if we just go on to the next slide, this is the legislation here. The whole transaction is brought into the ADS charge because if they are satisfied by one of the buyers, then they're treated as satisfied by all of them. That's effectively what paragraph 5 is doing. On to the next slide. Within 18 months of buying the joint property that Dr. C and Ms. S now lived in as their main residence, Ms. S sold the second property, her prior main residence. So at this point, both Dr. C and Ms. S have disposed of their main residences. They only own one property between them. And the property that triggered the ADS charge, the second property, is gone. It's out of the picture. So you would think kind of logically, but also fairly, Dr. C and Mrs. S should have been able to recover the ADS, but Revenue Scotland and the tribunal denied that recovery. If we go on to the next slide, we can start to explain why. So the first thing is, just to recap, they're relying on paragraph 5 here, the rule that says if one buyer triggers the ADS, then it applies to the whole transaction. They're not relying on the single economic unit provisions. But paragraph 5 here, like the single economic unit provisions, only works in one direction. It works to bring people in to the ADS charge, but it doesn't bring people back out of it. It only applies to those provisions that trigger ADS. So now we need to look at the ADS reclaim provisions, which are paragraphs 8 and 8A on the next slide. So the relevant one here is paragraph 8. 8A, which was brought in to try and remedy these kind of situations, isn't applicable, and it's not applicable for a well-known reason, which is that for 8A to apply, both parties have to have lived in one of the dwellings as their main residence. So they have to have lived together before they carried out the purchase, and these taxpayers didn't. So that's not important. So we then have to fall back on the basic reclaim provision, which is paragraph 8. And paragraph 8, on the surface, looks like it helps us here. It says, you know, within 18 months, the buyer has to dispose of ownership of a dwelling, and it has to have been their only or main residence during the 18 months before the effective date of the transaction. But what the tribunal and Revenue Scotland argued, and I think, unfortunately, they're probably correct in taking this view, and there are two routes you can take to getting there, is that the buyer in this case is Dr. Christie and Ms. S together. It's both of them. And so in order to fall within paragraph 8 and be entitled to a reclaim, both of them have to have disposed of a dwelling that was their main residence. Now, it doesn't have to be the same dwelling, but both of them have to, if you like, together or independently meet this condition in order for the ADS reclaim to be allowed. We just flip on to the next slide. This kind of has two, I think, absurd results. Number one, and this just can't be what the government's policy was, any transaction where you have joint buyers, where one of them triggers the ADS, then everyone individually has to meet the repayment conditions, and not just the person who's triggered the charge in the first place. So it's not enough to get rid of the offending property. Everyone has to get rid of an offending property as well, and you all have to fall within that same provision, paragraph 8. Secondly, the other absurd result is that the taxpayers, had they seen this coming, could possibly have avoided it. And the way they could have avoided it is if Dr. Crawford had sold his flat the day after the effective date, the date after they bought. If he had done that, then both he and his partner would have been within paragraph 8 and would have qualified for a reclaim. But because he didn't, because he sold it on the effective date, and thus, if you looked at him in isolation, was never within the ADS charge in the first place, he couldn't then bring himself back out through paragraph 8. So selling one property on the day and one later, bad, but selling both afterwards, good. I think on any level of basic fairness, that is an absurd and a surprising result. Unfortunately, the Tribunal and Revenue Scotland just don't have discretion to consider fairness when they're applying the ADS legislation. And so that's the result that you get. Now, on that topic of fairness, I'm going to hand back to Isobel, who's just going to update everyone on the ADS consultation.
Thanks, Bob. Before I do that, we do have a question which related to the multiple dwellings relief. So I'll just answer that. In the student PBSA sector, this question says, and specifically regarding cluster flats, which is where you have several student bedrooms and a shared kitchen and lounge. What is the dwelling in that situation? Is it the entire flat or is it one of the cluster bedrooms? And the answer is that it's the entire flat. So it's the 6 or 7 clustered bedrooms and the shared kitchen and lounge all taken together, which is treated as one dwelling. And that's because a dwelling has to be sort of self-contained. So studio flats where the student or other occupier would have everything within one flat, those are counted as a dwelling, but cluster flats, it's each cluster that's counted as one dwelling. So I hope that helps. On the ADS consultation, what's happened is that the Scottish Government launched an inquiry call for evidence and views in December 2021, which closed recently in March. And it's looking at various questions. Should the length of time available to purchase a new main residence be increased from 18 months? In the other parts of the UK for SDLT and LTT, it's 36 months. And I think everybody responding to this consultation has said that yes, it ought to be increased and it probably should be increased to 36 months to avoid confusion and to bring things into line. And the same applies to the time in which you can sell your previous main residence. Again, should it be increased from 18 months? Yes, and probably to 36. What about inherited property? Often low value inherited property can count against you for ADS. And that doesn't kind of seem fair because you don't have a choice about whether you inherit property or not. So should there be some grace period during which you ignore it? The next question on the next page deals with divorce and separation. Because of the joint ownership rules, which Bob has mentioned, even when a marriage is broken down and the parties have separated, they're still caught by the joint ownership rules, which means that the party leaving may well have to pay ADS on the purchase of a new dwelling. So what should be done about that? Also, the joint buyers economic unit issues, which Bob was alluding to, for getting into the ADS economic units of husbands and wives and so forth, and partners are treated as owning things which each other owns, but not for getting out. So should there be more symmetry? Should there be a relief from ADS for local authorities and housing cooperatives buying properties for affordable housing? And again, I think the answer that most people have put to that question is yes. It doesn't seem right that the money that's provided by the government for affordable housing should be wasted effectively because it's being used to pay ADS. And finally, should there be an exceptional circumstances provision if taxpayers haven't been able to reclaim ADS because they haven't been able to dispose of their former main residence within the statutory time limits? And again, I think most people responding have welcomed the idea of that, although accepting that it would need to be in fairly restricted circumstances. So Scottish Government are now looking at the replies to the ADS consultation, and we expect an announcement later on in the summer and perhaps legislation next year, although it depends if some of these things can be done by statutory instrument, they may be done sooner. moving on to a couple of points about market value. There's no general market value substitution rule for LBTT, so you don't generally have to substitute, but you do if it's a purchase by a company from a connected party, and you have to substitute market value if it's higher than the consideration, even if there's no actual consideration at all. This rule also applies if the consideration includes shares, but that's much less common. There is a carve out from this market value rule if you transfer property by way of a distribution. And that's why I think on the next slide, you can see that for intergroup transfers, you often do use a distribution. So if you were selling property from company from company B to its parent company for its net book value of 100,000, market value of 500,000, LBTT would be potentially payable on the 500,000. You could claim group relief, but group relief has clawbacks and conditions and so on. So in this situation, as we can see on the next slide, if you can, it's better to distribute the property because there's no consideration for a distribution generally. The market value rule doesn't apply. You don't have to worry about group relief clawbacks and so on. So you can distribute the property and not have a charge. Incorporation is a case where, as we can see on the next slide, transferring to a connected company will automatically bring you into the market value charge. Oh, actually, before that, what is the market value? It's a price reasonably expected to be fetched in a sale between a willing buyer and a willing seller. And it doesn't include VAT, though a valuation may be required. So just back to incorporation, there's no incorporation relief, market value rule will apply. But if the business is carried on by a partnership, then the special partnership rules may help. And these are the rules which apply where property is transferred by a partner to a partnership or by a partnership to a partner, and they reduce the market value on which LBTT is paid to the amount that's actually acquired by outsiders. So on the next slide, we can see if Mr. A and Mrs. A carry on a business in partnership and set up a company in which they own all the shares, the company will be connected. So the market value rule would potentially apply, but the partnership rules overtake that, and because everybody's connected, there's actually no LBTT charge at all. So on the incorporation of a business, you can get a good LBTT result if it's carried on by a partnership. Moving on to Bob now to make some comments on the VAT change that we mentioned.
Yep, this is RCB 222, which is the follow-up to RCB 1220, which was released in September 2020, and about which tax people have been talking non-stop. The basic idea behind RCB 222 and 1220 before it was that the sort of long-standing assumption that things that are contractually defined as compensation payments are outside the scope of VAT, that assumption is wrong. And in fact, what you have to do is consider whether those payments form part and parcel of the payments for supplies that you're getting under a contract. I don't want to go into detail about the European cases that underpin this or the detail of the change, but what I do want to do is just highlight how for leases and development contracts, this will have some kind of wide-ranging changes that will apply from the 1st of April this year. And about that date, the 1st of April, there's no grandfathering provisions. So leases that are entered into before that date will still be subject to these rules. What matters is really the date on which a VAT invoice is issued or a payment is made. First up, termination payments under leases. This is the major one. This is where a tenant pays a landlord to terminate the lease. In the old world, if that payment was accounted for in the terms of the lease, it was treated as outside of scope. It's only if you had to exercise a break option kind of outside of the lease, and it was a negotiated option that you were paying for, that would apply. Now, HMRC's view is that from 1st April 22, these will be parts of the payment for the underlying supply of land, i.e. those termination payments will be part of the payment for the lease. And therefore, if the landlord has opted to tax and that option applies, then that will be payable on the termination payment. So that's an important thing to be mindful of. Secondly, liquidated damages. These will also be affected. Specifically, I think payments from the customer to supplier. So for example, delay payments paid by a developer because it's not hitting key milestones under a development contract will also be subject to VAT if the subject matter of the contract is. So if you are developing commercial property, chances are VAT will apply. It's less clear if you're developing something like build to let, but there is at least an argument there that you might be able to zero rate the payment. Small bit of good news, and one of the things that has kind of caused the most anxiety is what the VAT treatment of dilapidations would be. After lots of industry representation, HMRC have now concluded that dilapidations aren't payment for the supplies under a release and are therefore generally outside of scope. However, either as a face-saving measure or as just flagging a genuine concern, HMRC have said in their revised guidance that in some cases where rents are being manipulated as part of a dilapidation settlement, then they might class the dilapidations as taxable. In other words, I suppose, if you are agreeing to make a dilapidations payment prior to the termination of a lease in return for a reduction in rents, that dilapse payment might be treated as effectively rent and therefore taxable. The other bit of good news, of course, is that these changes aren't retrospective. Under the old document that came out in September, they were going to look back 4 years and require taxpayers to correct anything from the last 4 years, but that will no longer be happening. So we've got a few minutes left for questions. Do feel free to type them into the Q&A box or the chat. We've got another question that came in through the chat. 2 questions, in fact. Number 1, is LBTT payable in relation to a property which does not exist in paper, i.e. it's not registered at the land register, specifically a tenement attic extension with no planning consents and no title? If someone buys that, then yes, LBTT will be payable on the purchase price if it's above £145,000. The fact that it doesn't exist on paper is a red herring. What is taxable here is the acquisition of a real right over land in Scotland, which ownership of that definitely would be. And presumably as part of the purchase, you're going to have to do a division of title and register that. Question 2, if LBTT does apply, then probably the purchaser of all flats in the tenement would have to claim multiple dwellings relief. If you're buying a tenement with multiple flats in it, then yes, multiple dwellings relief could be claimed, though you do want to do a quick check to make sure if you've got 6 or more. Would a claim for multiple dwellings relief actually result in higher tax than just paying the non-residential tax? The other point underpinning that is it's not immediately clear from the description whether this non-consented attic extension would be classed as a separate dwelling or not. That is really going to depend on the facts and to a large degree the physical layout of that extension. But there have been, as you might know from previous seminars, a number of cases where people have challenged or where the revenue have successfully challenged NDR claims around things like annexes. So I would be cautious about that, and I'd want to sort of review the facts thoroughly before I took a view on whether the extension was an extra dwelling.
It's a high bar, isn't it, to
It's
for something
quite
to
a high
qualify?
bar. The sort of the bright line test from the case law that's come out in the last couple of years is that independent third parties would be able to live in the extension as a separate dwelling. So it would give them all of the requisite facilities, but also independence and privacy from other dwellings round about.
We have another question about incorporation of businesses or property businesses, and this the fact that a partnership incorporation of a partnership can give you a better result than incorporation of a sole trader business, and how long do you have to operate the business through a partnership? The answer there is it has to be more than a couple of weeks. Obviously, it needs to probably involve maybe a year or so, at least, so that there are accounts, and so you can demonstrate that a partnership did actually exist, and has a business bank account and all the rest of it. And then you would be able to rely on the partnership rules. Some advisors suggest you can do this very quickly, but it's not always possible to do that so quickly. And obviously there are other taxes to consider in looking at these incorporations. We've only mentioned LBTT, but CGT will need to be looked at as well.
Yep, I think we have room for just one more question, which is on the VAT changes. Someone's asking, what about VAT on payments that go from the supplier to the customer? For example, damages where a developer has delayed and the developer is reimbursing the customer. In those cases, I think, although it's not explicitly covered in the HMRC guidance, in those cases, I think the answer is there would be no VAT payable, but that doesn't mean there might not be a VAT consequence. There should be no VAT payable because the underlying logic of this new HMRC guidance is that these so-called compensation payments are payments for a supply. They're payments for someone doing something. But under, say, a traditional development contract, the employer is not going to be making any supplies to the developer. And so without there being an underlying supply from the employer to the contractor, there's really nothing for this guidance to hook onto. The VAT consequence you may find is that, and again, this is part of the new guidance, where these liquidated damages from supplier to customer are paid, if they have the effect that they reduce the price under the contract, then the developer, the supplier may need to now issue a VAT credit note and refund some of the VAT and amend their VAT returns accordingly. So that HMRC used to take the view that you didn't have to do that, but I think concomitant with their views about things being compensation, payments going the other way can now be seen as reductions in compensation, not in compensation, consideration. Oh, and someone else has just popped in a message to say thank you for answering one of the earlier questions. You're very welcome. Okay, just to wrap things up now, if you do have any questions that you haven't asked or were too afraid to ask, please do feel free to contact me or Isobel at the email addresses or on the phone lines below. And also, we will be sending around a copy of the webinar, and there'll be a survey attached to that. We would encourage everyone to take the survey, please. It is a few clicks. It shouldn't be very taxing, but it does help us in how we structure our seminar programs and what kind of content we look to put out. So thank you everyone for attending. Please do fill out the questionnaire, and any further questions, do feel free to email.
Thanks very much.
Thank you.